Did you know that the type of investment fund you choose could significantly impact your financial future? Imagine this. Two investors start with the same amount of money, but one ends up with substantially more simply because they chose the right fund. But with so many options out there, index funds, mutual funds, and ETFs, how do you know which one is the best for you? In today's video, we're diving deep into these three popular investment options to help you make an informed decision and maximize your returns. So, if you're curious about how to make your money work harder for you, I remember when I first started investing, I was overwhelmed by the choices. I was sitting at my desk, staring at my computer screen, trying to figure out the difference between index funds, mutual funds, and ETFs. I felt like I was drowning in a sea of financial jargon, unsure of where to put my hard-earned money. It was a daunting task, but I knew that making the right choice was crucial for my financial future. Understanding the differences between index funds, mutual funds, and ETFs is essential for anyone looking to invest wisely. Each of these investment options has its unique characteristics, benefits, and risks. Mastering this topic can help you achieve better returns, save on fees, and align your investments with your financial goals. On the other hand, ignoring these differences could lead to missed opportunities, higher costs, and poor financial planning. In this video, we'll break down each of these investment types to help you make an informed decision and secure your financial future. If you want more tips on building wealth, hit the subscribe button. Your support helps us create more valuable content for you. What are index funds? Index funds are a type of mutual fund designed to track the performance of a specific market index, such as the S&P 500. They are passively managed, meaning they aim to replicate the performance of the index rather than outperform it. This passive management typically results in lower fees compared to actively managed funds. How do index funds work? Index funds invest in the same securities that make up the index they are tracking. For example, an S&P 500 index fund will invest in the 500 companies included in the S&P 500 index. The goal is to mirror the performance of the index as closely as possible, providing investors with a broad market exposure. Pros and cons of index funds. Pros: low fees. Due to passive management, index funds usually have lower expense ratios compared to actively managed funds. Diversification. By investing in an index fund, you gain exposure to a wide range of companies, reducing the risk associated with individual stocks. Consistent performance. Index funds aim to match the market's performance, which can provide steady and predictable returns over the long term. Cons: limited upside. Since index funds aim to match the market, they won't outperform the index. Market risk. If the overall market declines, index funds will also lose value. Let's take an example of the Vanguard 500 Index Fund. One of the most well-known index funds is the Vanguard 500 Index Fund, VFINX. This fund tracks the performance of the S&P 500 index, providing investors with exposure to 500 of the largest companies in the U.S. stock market. Imagine you invested $10,000 in the Vanguard $500 index fund 10 years ago. Over that period, the S&P 500 has averaged an annual return of about 10%. Your investment would have grown to approximately $25,937, thanks to the power of compound interest and the fund's low fees. By choosing an index fund like the Vanguard 500 Index Fund, you can benefit from low costs, diversification, and the potential for steady long-term growth. What are mutual funds? Mutual funds are investment vehicles that pool money from many investors to purchase a diversified portfolio of stocks, bonds, or other securities. Unlike index funds, mutual funds are typically actively managed by professional fund managers who aim to outperform the market by selecting specific investments. How do mutual funds work? In a mutual fund, the fund manager conducts research and analysis to make investment decisions on behalf of the investors. The goal is to achieve higher returns than the overall market. Investors buy shares in the mutual fund, and their returns are based on the fund's overall performance, minus fees and expenses. Pros and cons of mutual funds. Pros: professional management. Fund managers have expertise and resources to make informed investment decisions. Diversification. Mutual funds invest in a variety of assets, spreading risk across different securities and sectors. Potential for higher returns. Active management aims to outperform the market, potentially leading to higher returns. Cons. Higher fees. Active management and research come with higher expense ratios compared to passively managed funds. Performance variability. The success of a mutual fund heavily depends on the skill of the fund manager, and not all managers can consistently outperform the market. Minimum investments. Some mutual funds require a minimum investment amount, which might be a barrier for some investors. Let's take an example of Fidelity Contrafund. One of the most famous mutual funds is the Fidelity Contrafund, FCNTX. This fund is actively managed and aims to achieve capital appreciation by investing in companies believed to be undervalued or poised for growth. Suppose you invested $10,000 in the Fidelity Contrafund 10 years ago. Over that period, the Contrafund has averaged an annual return of about 12% thanks to the fund manager's strategic stock selections. Your investment would have grown to approximately $31,058, illustrating the potential benefits of active management. By choosing a mutual fund like the Fidelity Contrafund, you can leverage professional expertise, gain access to a diversified portfolio, and potentially achieve higher returns. However, it's essential to consider the higher fees and the variability in performance when deciding if a mutual fund is the right choice for you. What are ETFs? ETFs, or exchange-traded funds, are investment funds that trade on stock exchanges, similar to individual stocks. ETFs hold a collection of assets, such as stocks, bonds, or commodities, and aim to track the performance of a specific index, sector, or asset class. They combine features of both mutual funds and individual stocks, offering flexibility and cost efficiency. How do ETFs work? ETFs are designed to replicate the performance of a particular index or asset class by holding the same securities in the same proportions as the index. Investors can buy and sell shares of ETFs on stock exchanges throughout the trading day, just like individual stocks. This makes ETFs highly liquid and accessible. Pros and cons of ETFs. Pros: low fees. Like index funds, ETFs typically have lower expense ratios due to passive management. Liquidity. ETFs can be bought and sold throughout the trading day at market prices, providing flexibility for investors. Diversification. ETFs offer exposure to a broad range of assets, helping to spread risk. Transparency. ETF holdings are disclosed daily, allowing investors to see exactly what they own. Cons. Trading costs. While ETFs have low management fees, frequent trading can incur brokerage commissions. Market fluctuations. The price of ETF shares can fluctuate throughout the day based on market demand, potentially deviating from the underlying asset value. Complexity. Some ETFs, like leveraged or inverse ETFs, can be complex and carry additional risks. Let's take an example of SPDR S&P 500 ETF, SPY. One of the most popular ETFs is the SPDR S&P 500 ETF, SPY. This ETF tracks the performance of the S&P 500 index, providing investors with exposure to 500 of the largest publicly traded companies in the U.S. Imagine you invested $10,000 in the SPDR S&P 500 ETF 10 years ago. Over that period, the S&P 500 has averaged an annual return of about 10%. Your investment would have grown to approximately $25,937, similar to an investment in an S&P 500 index fund. By choosing an ETF like the SPDR S&P 500 ETF, you can benefit from low costs, daily liquidity, and broad market exposure. ETFs offer a flexible and efficient way to invest, making them a popular choice for both novice and experienced investors. We've explored the key features, pros and cons of index funds, mutual funds, and ETFs. Index funds offer low fees and consistent market performance, making them a great choice for passive investors seeking broad market exposure. Mutual funds, with their professional management and potential for higher returns, are ideal for those willing to pay a bit more for the chance to outperform the market. ETFs combine the benefits of both, offering low costs, high liquidity, and diversification, along with the flexibility to trade like stocks throughout the day. Choosing the right investment option depends on your individual financial goals, risk tolerance, and investment strategy. Whether you prefer the steady approach of index funds, the active management of mutual funds, or the flexibility of ETFs, understanding these options is crucial for making informed investment decisions. If you found this video helpful and want to see more content like this, please consider subscribing to our channel. Your subscription is like a donation that allows us to continue creating valuable and informative videos. Hit the subscribe button, and together, let's build a community of financially empowered individuals. Thank you for watching.